Forget everything you read on Twitter this weekend. Forget the panic selling, the whole end of the world thing that's been going on recently, and the one uncle that told you that silver was the boomer rock just before it hit $120. There was euphoria for everyone. I was one of them. Most people spent Friday watching their portfolios absolutely bleed out like a victim from a 90s slasher movie. Silver ended up plummeting 39% in a single session. If you're a beginner, that looks like a total collapse. If you're an intermediate trader, it looks like a black swan. It's an opportunity. But to me, it looks like a crime scene. And it looks like a crime scene where the detectives are also the suspects in the situation. You see, while the retail world was busy having a collective nervous breakdown, something very bizarre was happening in the shadows. The mining stocks, the companies that actually pull this metal out of the dirt, did something they never do during a real crash. They stayed standing. And today I am going to show you why this crash was a manufactured heist, who essentially left their fingerprints on all of the data, and why the physical market is currently screaming that the paper price is a total lie. There is a total disconnection between the two at the moment. You see, in a normal, healthy market, there is a fundamental law, and that is that miners are a leveraged play on metal. Think of it like this. If silver is the car, the miners are the turbocharger. If silver goes up 10%, miners usually jump 20%. If silver drops 10%, the miners usually tank 20%. And essentially, sometimes it can be more of that, and that's usually because their overhead costs don't change just because the price did. Now, I'm sure you're all aware, on Friday, silver got hit with a 39% wrecking ball. It was a bloodbath. And based on decades of data, the silver miners, the ETF 𝗖𝗧, should have been absolutely vaporized. It should have dropped 60 to 80%. It's happened before in the past. But instead, it dropped only 22%. Makes no sense. Absolutely no sense whatsoever. So the price of the product that they sell dropped by nearly half, but the smart money, the big institutional whales, refused to sell their shares. Now, they didn't panic, they didn't dump. Why? Because they knew the spot price, the price that you see on your screen, was just a temporary illusion. They knew that while the paper price was being manipulated, the companies holding the actual rocks were safer than ever. Now, they weren't holding the bag, they were essentially holding the exit door while you were being ushered out into the furnace to burn into flames. This was not market volatility. It was a choreographed 72-hour execution. Now, let's look at the actual timeline, because it is just like a goddamn Hollywood script. It is unbelievable how it played out. On Tuesday, the administration hints of a weak dollar policy. So to a trader, that's a green light to go and buy precious metals. Everyone piles in. The silver squeeze 2.0 was officially on. Everyone went to buy silver and gold because of the reduction of cost of the dollar. The dollar was getting pushed down. Makes sense. Thursday night, silver then went and hit a staggering $121. Retail investors were doing victory laps. It was euphoria. I was one of them. I was over the moon. I mean, it was worrying because it was unbelievably high, but with the shortage of silver for solar panels and technology, it kind of made sense. Friday morning, 6 a.m., before market even opens, before you've managed to have your coffee, the trap snapped shut. The president announced that Kevin Warsh was going to be the new Fed chairman, and Warsh is the ultimate strong dollar hawk. He wants interest rates and he wants the US dollar to go higher, which ultimately pushes silver and gold down. It was a total 180-degree reversal in a policy signal in less than just, 3 days? It forced every single person who bought silver on Tuesday to sell or be liquidated on the Friday afternoon. And it erased 40% of silver's value in 6 hours. But here's the kicker. While you were being liquidated, the banks were cleaning up. Now, let's talk about spoofing. I'm going to try and explain this to you and give you an example. Imagine I want to buy a car for $5,000. okay? This is your car. I want to buy your car for $5,000, but you want $10,000. I then call 10 of my friends and I get them to post fake ads online selling the same car for $4,000. You see the market dropping and you panic. You're like, oh my God, it's cheaper. So you decide to panic sell to me for the $5,000. And then my friends delete the fake ads that they posted. That is what spoofing is, and it happens in the stock market. So it's highly illegal, and guess what? The biggest banks in the world are essentially professional spoofers. JP Morgan, for example, paid $920 million in fines in 2020 for doing exactly this to the silver market. Their head of precious metals didn't just get a slap on the wrist, he was convicted of racketeering. I mean, we are talking mafia level charges, a huge criminal offense. HSBC, Deutsche Bank, Scotiabank, they all got caught and they all got fined hundreds of millions of dollars in rigging the market in exactly the same way. Now, let's check the COMEX delivery report for Friday. Now, you may have seen this going around the internet quite a lot recently. On the exact day of the crash, at the exact bottom of the price action, JP Morgan stopped, otherwise known as closed, 147 contracts. They exited their short positions at maximum profit precisely when the pain was highest for retail. Morgan Stanley, HSBC, they were right there with them. All these big boys were right there with them, selling their shorts on silver at exactly that point. Now you're telling me the same banks that were convicted of rigging silver just so happened to time the biggest crash in history to the second. If you believe that, I have some beachfront property in Nebraska to sell you. That to me doesn't make any sense. The paper price says silver is $75, but try going to a shop and buying it for $75. It's impossible. This weekend, Golden State Mint, one of the largest private mints in the US, had to shut down sales, and their reason was they couldn't secure silver. Think about that. If silver is already overflowing and the price is crashing, why can't a massive mint find any metal to buy? And the answer is that the physical market has completely disconnected from the paper market. While the spot price was tanking, dealers were charging premiums of 50% to 100%. People were paying $130 an ounce for physical coins, while the screen said $75. There is a huge demand for silver in the market at the moment, especially within technology, solar panels, and a bit of everything, to be honest with you. It is in demand. And then the CME group, the guys who run the exchange, they stepped in. They didn't lower the margins to help investors. They raised them. Twice in 3 days, a 36% hike overnight. So what does this mean? Well, raising margins after a crash is a bit like kicking someone who just fell off a ladder. It forces anyone who survived the initial drop to sell their remaining holdings. It's essentially a liquidation machine designed to clear the path for the banks to exit their shores. Now, we have seen this movie before. In the 1980s, silver hits $50. The exchange then changed the rules, the Silver Rule 7. They changed this overnight. Silver then crashed 80%. In 2011, silver then went and hit $50 again, and the CME raises margins 5 times in 9 days. Silver crashed 50%. 2026. Silver hits $121. The Fed flips the script. Margins are hiked to emergency levels, and silver crashes 39%, even when it's in a huge amount of demand. Every time silver threatens to expose the weakness of the dollar, the same playbook comes out. But there's one big difference this time. The physical shortage, which I've mentioned throughout all of this, is worse than it has ever been. Silver isn't just jewelry anymore. It's not something you wear on your earrings. It's not a necklace. It's not a ring. It's in every solar panel, it's in every EV, it's in every piece of AI hardware. You can manipulate a digital ticker, but you cannot spoof a physical ounce of silver into a semiconductor. And there is a huge issue with the shortage of hardware, memory, and now silver within the semiconductor world at the moment. The miners didn't crash because the big money knows the recovery is going to be violent. They are holding the real assets whilst the paper traders are getting absolutely slaughtered. So if you're a retail investor, they want you to look at the $75 price and feel like a failure. They want you to sell your physical stack back to them at a discount, but don't let them. The physical market is broken. The mints are empty. The banks have covered, and the game is far from over. It is one of the most in-demand precious metals on the planet at this point in time. So what is your move? Are you going to be holding your physical, or has the paper market finally scared you off? Drop a comment below. I'm reading all of them. I really want to know what your opinion is, because I know exactly what I am going to be doing, and I will not be scared off. I am prepared and I am going hard. Let's see what happens.